Tom Lee, the stock market is getting stronger.
The tape, what it will take to keep stocks moving even higher from here. Let's ask FundStrat's managing partner and head of research, Tom Lee. He is with us live today. Tom, welcome back.
Thank you, Scott. Good to see you.
Yeah, you too. This is a remarkable market. What is driving this, and what is driving this continued acceleration as we hit this final stretch today?
Scott, I think 2024 is revealing the stock market is getting stronger because it is proving to be extremely resilient. You know, last week Tesla fell 11%. The S&P was up for the week. This week we had two big fangs miss and disappoint, and the market's, of course, roaring as we end the week. It's the 14th consecutive week. I think it has a lot to do with, one, the economy's incredibly resilient. The Fed, I think, has turned dovish. We don't know the timing of the first cut. Inflation, I think, is falling basically like a rock. And we know there's a lot of cash on the sidelines because there's over $6 trillion sitting in money markets. And yet the S&P, is just in the last 6 weeks generated more return than an entire year of owning money market cash.
Yeah, it's been unbelievable. So March doesn't matter? I mean, is that the lesson of this week?
Yes. I think, I think the bond market really cares whether it's May or March. I think that the stock market really should just care that the Fed has gone from fighting inflation and almost giving the economy a heart attack to one where they're trying to manage the business cycle. So if they don't feel comfortable doing this cut in March and instead of May, I don't think it should have any effect on equities and how they do today.
The interesting part, I guess, is what you allude to. It's sort of this change in focus of the Fed. And I think Chair Powell alluded to this as much in the news conference when he cited, I think on multiple occasions, the strength of the labor market is not necessarily a bad thing anymore, so to speak. They don't feel perhaps as though they need to really lean on that to get inflation to come down because they've been surprised to the degree that it's already been coming down.
Yeah, that's right. I think the biggest evidence this week was the ECI, the Employment Cost Index.
Let's go ahead and take a look at one of the most important things in the entire stock market if you want to understand what's going on with inflation, okay? Here we go, baby. I'm going to show you it right now. Okay? So, GSG, the commodity index, arguably the most important thing if you really want to understand where inflation's going. It's GSG. This is a commodity index. It's, a good gauge on what's actually going on in the commodities market. And this is a 1 year on GSG and has gone absolutely nowhere. It's down a little less than 1%, right? Down about 0.5%. So that right there, folks, is very, very important. If this was spiking up huge, all of a sudden it's 23, 24, 25, 26. You might want to start to worry about inflation. Inflation could be coming down, coming down the road, right? If, it's staying kind of flatlining, that's pretty good overall. If it's crashing completely, then maybe you're in a recessionary environment, right? But we went through one of the, arguably the biggest bull run in GSG in the history of GSG. I mean, that was ridiculous, right? All the way from those lows in kind of April of 2020, all the way through the peak there in around summer 2022. It was ridiculous. And those days are long gone. So, and if you look overall, we could potentially still come down in GSG. I mean, a high GSG before Rona was 16 there, right? That was kind of elevated ranges. Prior to that, right here was 2018, and we were at 18 there for GSG, right? And that was a peak in 2018. Right here was a peak, 18. So you were looking at a GSG at 20. Keep in mind, folks, we could still come down to 16, 18 on this baby, and not even be in a recession necessarily. If we are in some sort of, next time we're in a major recession, this baby's probably going to 10, I would say, somewhere around there. But keep in mind, there's still room for downside in regards to GSG. If I had to guess, I would say it would probably go up a little bit. I would think over the next, 6 months, as I think oil prices will do decent over the next, 4 to 6 months. But, B-Man in office, I think he's going to try to, have as much fracking going on in oil production as possible going into, the big election there. So I don't know, man. We're looking pretty good. That's all I'll say about that.
It came in very tame, and Fed Chair Powell barely mentioned the labor market in the last press conference. I think it's because the job market is still adding jobs. I mean, today was a big surprise, but the unemployment rate's not really falling precipitously, and it's not creating a lot of wage pressure. So far, I think the labor market isn't going to be the source of the concern for the Fed.
Yeah.
Well put, Tom Lee. Well put. Okay. All right. Let's talk a little economics now. U.S. economy added 353,000 jobs in January.
Got the number in just 2 seconds. Rick?
That's a couple of seconds. The first jobs report, jobs of 24 is out, and it is whopper 353,000. 353,000. We have to go in the Wayback Machine. That is the biggest non-farm payroll gains since January of 23, when it was 472,000. And if we look at the unemployment rate, it is 3.7. It's remained at 3.7. And just for history's sake, the 3.4 low that we had was the lowest since 1953. That was in April of last year. If we look at the average hourly earnings, a huge jump, up 0.6%, up 0.6%. It equals March of 22. To find a higher number, you have to go to January of 22. And also, for some context there, the amount of year over year is also popping 4.5%. We were expecting 4.1. The year over year average hourly earnings began as a data set in 2007, pre-COVID, all the way to when it started. The high was 3.6. It's 4.5. 4.5 is the highest level going back to February of 23. If we look at the average work week, 34.1, that is a drop. It's been at 34.3 or 34.4 going all the way back pretty much to beginning of last year. So that dropped 34.1. I don't even know if I have a record going back. That equals March of 2020. And 62.5 is the labor force participation rate. And if you recall, 62.5 was last month as well. It is going in the wrong direction. Finally, the underemployment, or U6, moved from 7.1 to 7.2. 7.2 is the highest level in that series since Dece of 21. Interest rates are popping, equities are dropping, and this is a report filled with strength surprises. And if you're thinking that average hourly earnings year over year or month over month is going to be something that Chairman Powell and the Federal Reserve Board studies, you're darn tootin', that's correct. Andrew, back to you.
Yeah, so, you know, in my opinion, going to be in, for a little bit here, we're going to be in the fun part of the economy. What's the fun part of the economy? Low unemployment and real wages that are, you know, in a very good place. And that's kind of what I foresee for 2024 for the most part is, you know, low unemployment, 4% or under, and a situation where real wages are looking great. Now, at some point that will change. It might be a year from now, a few years from now, right? And we'll have the next recession, we'll have an unemployment cycle, those sorts of things. But for right now, this is you know, kind of a fun part here for a bit. And you know, it's good news overall, because certainly we've had a low unemployment rate for a while now. But the problem was 22 and 23, and even part of 21, people's real wages were not in a good place. Real wages were actually going down for several years in a row, and continue to be in a bad spot up until very recently. And when I say very recently, I'm talking really over the last 3 to 6 months. Folks have finally started to feel a breath of fresh air in the middle class and feeling like, ooh, man, you know, maybe things are looking a little better, because now you don't go to the grocery store and everything's massively more expensive. We go back a year or two years ago, it was like every single time you went anywhere, it was like, oh my gosh, this price just went up again and again and again. That's not going on anymore at this point in time, right? And so that's a positive benefit overall there. So that's why I say this is a fun part of the economy here for a little bit. All right, next one up here, December factory orders rise 0.2% in line with expectations.
Up in the street, Rick Santelli here, live at CMEHQ with the last breaking news of this wild week. University of Michigan sentiment. These are January finals. We will replace mid-month reads. 78.8 now becomes 79.9. Still the best since July of 21. And
79.9 Michigan Consumer Confidence Index. So let me be very clear. That's definitely improving massively. We hit the lowest in the history of that survey, which goes back all the way back to the 1950s. We hit the lowest in history in 2022. So, which tells you how bad things have really gotten, right? Really great to see confidence improving among the consumer. That's still not even a great number, though. Keep that in mind. We have a long way to run. Like, we could have easily a year plus of getting that confidence back in a better and better place. That confidence is not high right now. It's okay. That's the best way I could describe it, is we've gotten back to an okay place, but we've got a lot of improving to do when it comes to consumer confidence.
Current conditions.
And if the longer the consumer's in a place where real wages are outstripping, let's just call it, we're gonna be in a much healthier environment. People are gonna feel more confident. People don't feel confident when either they can't get a job. Well, one of two things kills a consumer. They feel like they can't get a job. They hear everybody's losing their job. That hurts, right? That's when you're going through a big unemployment cycle like we went through in the Great Financial Crisis, or what we went through obviously in Rona there in the short term, right? Or a second thing that kills consumer confidence is inflation. When, it feels like I can't get ahead because although I'm working, it's just like everything's so dang expensive and the prices just keep going up. Finally, we're at a place where the prices aren't just keep going up. So, that's good news. Obviously, there's always going to be a little bit of inflation, but people can deal with 2 to 3% inflation. It's when it's like 8, 9%. No, that's going to destroy consumer confidence when you're dealing with that.
From its mid-read from 83.3 down. This is unusual. That's a pretty big move. 81.9 down to 81.9. That would end up being the weakest since the end of last year when it was 73.3. Why, you ask? Because 83.3 was such a big jump. Also, before the change of that mid-month read, that was the best since July of 21. Expectations moved from 76.0 to 77.1. 77.1 is the best going back to July of 21. Now, let's go to the important things. 1 year inflation, the mid-month read 2.9, it remains at 2.9. And finally, 5 to 10 year inflation, last look on mid-month read, well, it was 2.6. Now it moves to, it was 2.8. It moves to 2.9. So 2.8 to 2.9. 2.9 is the highest level of inflation there since the end of last year, November of 23, when it was 3.2. Now, factory orders, these are fresh numbers. These are December numbers. We're expecting up 0.2. It arrives at up 0.2. You strip out transportation, it doubles to up 0.4. So we could see that aircraft orders most likely were a bit of a drag on this number. And if we look at durable goods, now these once again are final reads, which means the mid-month read gets tossed out. Mid-month read was unchanged. It remains at unchanged. Ex-transportation, initial read 0.6. It moves down to 0.5. And finally, capital good orders, non-defense ex-aircraft, a proxy for capital business spending. Well, last look, mid-month, it was up 0.3. It is now up 0.2. So we lose a bit there. Interest rates, well, interest rates have had a lot of movement. Before the number, a 10-year note yield, for example, was down 12 on the week. Down 26 on the week. Now it's only down half of that. Sarah, back to you.
Good info there, Rick Santelli. We all appreciate that, okay? Next one up here, more money to be made picking stocks over buying indexes.
In those 7 stocks.
So it's interesting because I feel like even though we all think of the market as being just this one direction, 7 companies leading the charge, the stocks themselves are acting very differently. And if you just measure idiosyncratic risk as like kind of non-market specific risk, we've actually seen a surprising increase in stock specific risk. So what this means in English is that you can actually make more money picking stocks than just buying the index outright. And that's been our call for a while. I mean, I think what's been a little bit unnerving about this year and the last few months is that we haven't necessarily seen a broadening pattern emerge in the market. We're still seeing leadership pretty decisively in this cohort. But look at what happened after earnings for some of these companies. I mean, these stocks are priced for perfection. Everybody owns them. They're pretty expensive, maybe not, as expensive as prior tech bubble levels, but they're relatively healthy in terms of valuations. And I think that What happens from here is a broadening to other areas of the market that aren't necessarily as risky as we think.
We say they're priced to perfection, then they're running another 20% in a single day. It is scratching my head. I just wonder what the takeaway from Friday's price action is.
So, you know what I think was interesting is that one of the drivers for that big bump was initiating a dividend, a big growth company initiating a dividend. And I think that's a really important signal because, you know, our call is that we're at a point where the next leg higher in equities is likely to be retirees maybe moving out of cash back into riskier sources of yield. Of course, this was predicated on the idea that the Fed was going to start cutting interest rates, which obviously is, you know, a bigger question today when that happens, you know, kind of how much, how soon. But I do think that the idea of this wall of cash sitting there in money market and short duration bonds that's earning 5%, if that starts to come down, or if you start to see equity yields come up like we are in certain parts of the market, I think that could be the value proposition for equities again. It's kind of like TINA 2.0.
Yeah, so the point she makes about, you know, stock picking over just buying the indexes, obviously I'm 100% on that train. I don't think that comes as a surprise to anybody out there, right? I've been on that train for the last 15 years and I'll be on that train forever, right? Now, you know, here's the problem, right? If we go ahead and we judge the S&P 500 against just some of the most famous stocks in the market, right? The performance is so dwarfed that a lot of people say, dang, man, like, why am I not just in some of these super famous stocks that are, you know, are just destroying the market? This is just a 1 year, right? Nvidia's up 228% versus S&P 500 up 20%. Uber stock's up 104% versus 20% for the S&P 500. Apple, their numbers haven't even been good, and even Apple is outperforming the S&P 500 with a 24% gain in the past year versus 20% for the S&P 500. Google, 40% double up, and Google's not even had that great of a time, and it's still doubled up the S&P 500, right? Intel like is always known as a dog stock, and even that stock 49% gain versus 20% for the S&P 500. Salesforce 70% versus 20%. I mean, it's stock after stock. Micron 45% versus 20%. Oracle 31% versus 20%. Intuit 54% versus 20%. Netflix 55% versus 20%. Palo Alto Network, these are the most famous stocks in the entire stock market, 108% versus 20%. PayPal's underperformed. Okay, PayPal, we got one, at least there. Okay, even IBM, 35% versus 20%. Adobe, 67% versus 20%. Amazon, 70% versus 20%. Microsoft, 58%, so almost a triple up of Microsoft here, 58% versus 20%. Snowflake, 36% versus 20%. Shopify, 58% versus 20%. AMD, 106%, so a 5x of the S&P 500. Meta, Meta, 151% versus 20%. And I think Tesla's underperformed. So Tesla's underperformed. So out of those super famous stocks, right, only two have underperformed the S&P 500. Only two. And the problem is most of those that outperformed the S&P 500 didn't just do it by a bit. It wasn't like it was up 22% and the S&P 500 was up, 20%. The fact is, those stocks, we're talking about they're 5xing, 10xing, 3xing the S&P 500 just in the past year, right? It pays much better to know what you're doing in the market, to learn this stuff and be a stock picker, because the gains you can get over time are just so far dwarfing, like, what you would get in the S&P 500 or something like that, right? Never mind, you got to obviously pay fees to be in an index fund or an ETF or something like that.